So this is the second part of the credit risk and credit derivatives. So we were looking at interest rate dynamics of a firm in financial distress, and we saw that Vasicek model can help us to read some of the things here, and the value of debt and the value of equity can be compared using the Vasicek model. In case of financial distress, just remember this thing: the firm would behave very differently in times of financial distress and when it's not in financial distress. So value of debt would increase only if theta increases, the theta or the long-term interest rate that we assume to a model, except that the value of debt would decrease when a firm is in financial distress for any case, whether it's speed, whether it's time, for anything. And just reverse of that is the value of equity. The sensitivity of value of debt to changes in interest rate is dependent on volatility of interest rates. When interest rate volatility is high, debt values are less sensitive to change in interest rate. Therefore, hedging against adverse effect of changing interest rates depends on the parameters of dynamic rate models. Application of Merton model is complicated by the complexity of firm's capital structure. Most firms has variety of debt that mature at different time and have different coupons, not just zero coupons. In addition to many different types of debt issue, Merton model does not allow the firm's value to jump. Since most defaults are surprises, the inability to have jumps in the value of Merton models make it default too predictable. Empirical research confirms that predictability of Merton model, and there was a research paper by Jones, Mason and Rosenfeld reports that naive models of predicting were debt risky world better for investment grade bonds than for Merton model. However, Merton models work better when the naive model for debt is below investment grade risk. Ken Ramsay Sudarshan in 1993 reported that Merton model ability to predict credit spread. The documented problem with Merton model created the need for model to predict default more accurately, such as KMV model. Using Merton model to calculate probability of default and loss given default. The simplest case for calculating probability of default assumes that the process for default is not correlated with interest rate process or recovery rate. The recovery rate is a fixed proportion of principal that the debt holder receives in the event of the default. The recovery rate is not dependent on time. To find out the value of the debt, the probability of default and the recovery rates are required. If the debt is publicly traded, then probability of default and the recovery rate can be estimated from the current price of the debt. However, most of the debt instruments are not publicly traded. In addition to the lack of public trading, there are four differences in measuring risk of a debt folio that makes estimated probability of default and loss due to default more challenging. If securities are illiquid, then historical data is not reliable. The distribution of bondholder is not normal because debt holders cannot receive more than the face amount plus the sum of coupons. Debt is issued by creditor who do not have traded equity. That is not marked to market in contrast to traded securities. That is, loss is recognized only if default occurs. The Merton model for probability of default and loss given default assumes that the firm value is log normally distributed with a constant volatility and the firm only has one liability, which is zero coupon debt issue. The model also requires the expected return on equity of the firm. The Merton model probability of default, I am again repeating the formula that we have been repeating, is probability of default is equal to the cumulative normal distribution function, which would run on the whole thing. The whole thing has denominator and a numerator. The numerator has log of f minus log of v minus mu t minus t plus 0.5 sigma square t minus t upon sigma into t minus t. The loss given default is LGD is equal to f into probability of default minus v into sigma t minus t into n. Now, suppose a firm with value 60 million has a bond issue with a face value of 50 million that matures in 3 years. The current interest rate is 6% and the volatility of the firm is 25%. What is the probability of firm with default on its debt if the expected return on the firm mu is 15%? What is the expected loss given default? So we'll use the default formula and we'll get log of 50 minus log of 60. So this is the value of the firm is 60 and the value of the debt is 50 minus 0.15 into 3. Now 0.15 was the expected return of the firm into 3 is the time, 0.5 into 0.25 square into 3 upon 0.25 root 3, and that gave us the probability of default to be 10.6%. If you observe the thing, this is again made up of the same thing. If you observe the numerator, it's log 50 upon 60, and that's the return, and that's the return, and we subtract it from the return 0.50 and we add a volatility factor. So it all is related to the original model. Then we can use the loss given default is equal to 50 into probability of default minus 60 into present value of this thing, and the loss given default can be calculated also. Now the relationship between inputs of the Merton model and the probability of default, and then compares each relationship to the loss given default. So the probability of default PD, and it's negatively related to the value of the firm, positively to volatility, negatively to expected return, negatively to time to value, positively related to face value of debt. Loss given default is again very similar, negative to the value of the firm, positive to volatility, negative to expected return, negative to time value, and positive to face value of the debt. So relationship for PD and GD related to variables based on Merton model we have just calculated. Now if you remember that we are subtracting the return from the debt and adding some of the volatility parameters here and there to calculate the probability of default, and that is very intuitive of what we did into the Black-Scholes model, that we wanted to find out whether that tick would be that high price or the strike price would be touched or not. In this case we have the average return of the firm, and we want to find out whether that high downside will be touched or not, or that return on the downside will be touched or not for the firm's asset, because if that downside is touched, that means that the firm has already defaulted. Now we move to credit risk portfolio models. Describe the fundamental differences between credit risk plus, credit matrix, and KMV credit portfolio model. Portfolio credit risk model resolves some of the difficulties of measuring a portfolio's probability of default and the amount of loss associated when default using Merton model. The model also allows for inclusion of additional securities and contracts such as swaps. Therefore, instead of having only debt holders in the model includes other obligation. Obligation includes all parties who have a legal obligation to the firm. Using various methodology, credit risk portfolio model as attempts to estimate a portfolio's credit value at risk. Credit VaR, also known as credit at risk or default VaR, is defined much as the same way as market VaR. The minimum credit loss at a given significance level over the period of time, or alternative maximum credit loss for a given over a period of time. Credit VaR differs from market VaR is that it measures loss that are specifically due to default risk or credit deterioration. Like VaR, credit VaR is measured over a specified time at a specified probability. The two problems, however, is calculating credit VaR. First, calculating VaR over 1 day period is difficult. Therefore, credit VaR is usually calculated over 1 year, when the potential change of credit is more easily estimated. The second problem is that change in credit risk are highly skewed and do not follow normal distribution. The loss distribution in credit quality for investment grade bonds closely resemble log normal distribution. So, log normal distribution is only there for the investment grade bond and not for other bonds. Then we have credit risk plus. Credit risk plus measures the credit risk of a portfolio using a set of common risk factors for each obligator. Each obligator has its own sensitivity to common factors. The model allows for only two outcomes, default or no default for a fixed size. Probability of default for each obligator is dependent on credit rating and obligator sensitivity to each of these risk factors. Conditional on risk factor, the model assumes that default are uncorrelated across obligators. Risk factor can only have positive values and are scaled up to have a mean of 1. The risk factors are assumed to follow a specific distribution such as gamma distribution. If an obligator has a risk factor greater than 1, then the probability of default for a firm I increases in proportional to obligator's exposure. After the probability of default for each obligator is calculated, the loss distribution for portfolio can be estimated and used to assess the credit risk of the portfolio. Now we have credit matrices. Credit matrices is used for determining credit value at risk for large portfolio of debt claims. Steps used in credit VaR using credit matrix is steps determining rating classes for debt claim, using historical rating transaction matrix to determine probability that a claim will migrate. Estimate the distribution of value by computing the expected value of 1 year. Use 1 year forward zero curve rate to get current prices of zero coupon bond. Assume annual coupon to compute the value of bond for each possible rating. Compute expected bond value for each probability. Then compute the credit for a given confidence interval where P is probability of migrating for a given rating, BV is the bond for a given rating. So we take out all the probabilities we discounted today, and we do that and we try to find out what is the value. We are going to look at a mathematical calculation to understand the same that we were talking. So suppose we have a portfolio that consists senior unsecured bond issued the bond with its credit rating triple B matures in 5 years and pays 6% coupon. If the recovery rate is 51.13%, what is 1% rate were given the following 1 year forward, 0 rates for the next 4 years, 1 year transaction probability of bond with BB rating, assume bond market price to be 106. Now since we have this given to us the transaction matrix, we can find out various things that could happen to the firm. The bond value for the next year is calculated by discounting coupon rate and principal by appropriate forward rate. For example, the bond value for triple B rating is calculated as, and we'll use all forward rates for the double B rating, and we'll discount rates. So we have the future curve with us of double B, so that is having 5.55, 6.0 to 6.7 and 7.27. So we'll discount everything to today. Now the estimation of mean value of bond over 1 year probability of migration. Now they have given us that the bond is double B. So from a double B, the bond could go at A, double A, triple A, double, from triple B to double B, C and E. So probability of migrating from BBB can be calculated, and the sum of all these probabilities should be 100. Then the cumulative probability is given to all of them from default to AA, which is given 100. Now bond plus coupon. Now we'll discount everything with this path. So we have got spot rate for all these ratings with the probability multiplied by this value that we have discounted, and we'll add everything. The cumulated probability is then taken out, and the expected value of the bond at 90 of 98.1 is at 1.47 of the cumulated distribution is used as proxy. Since the credit war is the difference between current price and the first percentile price, the credit war with current price of 106 is estimated to be $7. Now we'll find out what is the probability that they are going to lose 98.1%. So on the upside they are not going to lose, on the downside they'll use this money, and there are probabilities of letting that happen. So we'll find out that. So the expected bond value is 98.10 at 1.47, and this is the probability that we are looking for, because we are being asked to calculate the probability at 1%. So this is the first percentile proxy, or the closest number that we have, and when this is going to happen, they are going to lose an approximate of money, that is 7.90. So we'll use that, and we'll calculate, and we'll subtract it from the so this is 98.10, which was the value, which is the present value of the bond if something like this is going to happen. And this is the worst case scenario with a probability of 1% that they'll go here. So we have converted the bond rating into probability into a different distribution, and there is only 1% probability that they are going to go below this to 83 and 51. So that is the current probability, 98.1. So we'll subtract this with the current price given to us, and we'll say that this is the loss that could happen at 1% confidence. Correlations are important in portfolio. If two bonds are independent, then probability of both bond migrating is the product of individual event. If the bonds are not independent, then we need to know the migration correlation. The measure complexity of credit metrics is estimating the joint migration of bonds in a portfolio. If historical estimates for joint probability are used, then additional information is required. However, stock returns are used to estimate correlation between bond issues. The problem is solved. Credit metrics recommend using a factor model where stock returns depended on country and industry as well as unsystematic risk. So that was a question of credit matrices where they have used everything. Now I'll quickly revise you the credit risk plus model. So the credit risk plus model measures the credit risk of a portfolio using set of common risk factor for each obligator. Each obligator has got its own sensitivity to common risk factor. The model allows for only two outcomes, default or no default, for a loss of the fixed size. The probability of default for each obligator is dependent on the credit rating and obligator sensitivity for each risk factor. Conditional on risk factor, the model assumes that defaults are uncorrelated across obligators. So that was for credit risk plus. Now we move to Moody's KMV Portfolio Manager. Previously we discussed KMV approach for estimating expected default probability. This approach is known as Moody's KMV Credit Monitor. Another model that is used on Merton model but is specifically designed for managing credit risk in a portfolio setting is Moody's KMV Portfolio Manager. KMV Credit Monitor provides data for Portfolio Manager. KMV model, the modified Merton model, calculates the expected default frequencies (EDF) for each obligator. This modified model allows us for more complicated capture structure. The KMV solves for a firm value and volatility. The primary advantage of KMV model is that the use of current equity values in the model. This allows for impact of current event to immediately affect the probability of default. Rating change occur with a considerable lag. The use of equity values allows a probability of default to change continuously as the equity price changes. In credit matrices approach, the value of the firm can change without any impact on the probability of default. The KMV model computes the expected return from the variation of capital asset pricing model, which uses factors to simplify correlation structure of a firm. This provides for direct estimation of loss distribution without requiring to use estimates uh, without requiring the use of simulation to estimate credit score of a credit portfolio. Then we have credit portfolio view. Credit portfolio view models the transaction matrices using macroeconomy or economic cycle. This is primary distinguished feature. Macroeconomic variables are the key drivers of default rate. Credit portfolio view estimates an economic model for an index that drives default rate or industrial sector. This model simulates path of index which produces distribution of portfolio losses to analyze. Using the focus is on aggregate default rate for the entire economy. So this view is taking macroeconomic factor, thus just remember this terms. The user can select the inputs for economic model. Examples often use inputs like GDP growth, interest rate, unemployment. In United States and other countries, this data is readily available from public sources. The default rates per industry and country may not always be readily available. In other countries, the progress must be used. The procedure can be summarized in 4 steps. Measuring the auto-regressive process of macroeconomic variable, composing sector indices for value, estimating default rate based on value of index, comparing simulated value to historical to determine transaction metric use. The second and the third part of the procedure consist of simulating future possible relation of index and then using an appropriate transformation like logistic transform or simulation so that they become a distribution of default rate. The simulation indicates that probability of default is above or below the historical average. Then this would include that the sector is a recession or expansion and they would lose a recession expansion transition metrics. Limitation of credit portfolio models. Now the view takes on macroeconomic factors, it regresses the macroeconomic factors, whereas the KMV portfolio manager use market prices so that you can find out instantaneous. The credit metrics that we talked about use the transaction metrics, so we are dependent on rating changes. And the credit risk plus find out sensitivities of the specific portfolio using common risk factors. So these were the different approaches which they were taking. Now limitations of credit risk portfolio models. Credit risk portfolio model have improvement at estimating the probability of default. However, most models do not account for changes in interest rate, credit spread, current economic condition. The state of economy does not the state of economy will affect the probability of default for bonds. As the economy moves from an expansionary to recessionary, the distribution of default changes. In 1991, defaults were at peak and then declined through 1990s as the economy expanded. The correlation increased during recession. Credit measures use historical correlation not able to account for changing economic condition. Now we have credit derivatives. Now just a small point here, and this is about the current economic condition and the historical. So there were bets on the credit default swap which says that as the economic cycle changes, things are going to improve. So some of the banks took some bet on the credit default swap indices of some countries where they saw that economy is going to change and they lost. So that was something of what the JP Morgan Blue Whale loss. You can check more on the Wikipedia to learn more about this. Now credit derivatives assess the credit risk of derivatives. Define and describe credit derivative, credit default swap and total return swap. A credit derivative is a contract with payoff contingent on a specific credit risk. Credit derivatives are designed as hedging instrument for credit risk. Credit derivatives are usually traded over the counter and not on exchange traders. Credit events include bankruptcy, failure to pay, restructuring, repudiation, moratorium, obligation, extension, obligation, default. One of the simplest credit derivatives is credit default put. Credit default put pays on a loss of debt due to default at the maturity of the debt claim at T. Now calculating the payoff of a credit default put. Suppose a fixed income portfolio manager buys a bond at a face amount 100 million that matures in 1 year. The payoff of risky bond is same as the portfolio owing to 1 year treasury risk of 1 year treasury bill and a short position of put return on the firm issue firm's value and excess price equal to face value of debt. To hedge for the carries, the issuer that will not pay the full amount, that holders can buy a credit default swap put on the value of the firm with an excess price equal to debt face value. What is the payoff of holding a risky bond hedge with credit default put if the firm's value is equal to 60 million. So firm's value, payoff of a risk-free bond, short position, risky debt, risk-free coupon, credit default, and hedged payoff. The more complex and popular credit default derivative is credit default swap. Credit default swap is typically swap in which one party is to makes payment to another. The purchase of CDS seeks protection will make fixed payment to the seller of the CDS over the life of the swap until the credit default occur. This differs from a typical interest rate swap where the net payments are based on some fixed and floating amount rates. So the underlying reference on a CDS whether a credit event takes place. If the credit event takes place, the buyer of CDS will make final accrual payment based on the amount time elapsed since the last payment. Then the swap is settled by either physical delivery or reference obligation or in cash. If the term of the swap agreement dictates settlement of by physical delivery, the buyer CDS delivers the reference obligation to the seller and receives at the par value. If the terms agreement are for cash delivery, dealer is surveyed a specific number of days following a credit determined midpoint between bid and ask, called Z, which will be used to calculate cash payment of 0 minus Z 100% of the notional value. Suppose F1 Advisors owns an fixed income security issued by ELF, the reference entity issuer, the reference obligation with a par value of 200 million, and these F1 Advisor would like to protect his position against credit risk by using a credit default swap, is able to purchase this protection of credit default swap for 75 basis point and notional principal of 200 million. The life of the CDS is 5 years, which will require FI to pay 1.5 million every year. If the ELF does not default, FI advise nothing for this agreement. If ELF does not default, will pay. However, if EFI does default, Matrix will pay the notional amount 200 million. The general CDS transaction can be seen as follows. So we have two blocks, 75 basis point per year paid and payment if default occur. Total return swap are agreement to exchange total return of a reference entity like risky corporate bond for a floating rate LIBOR plus a spread. Total return for a reference will include both capital gains and or co-instrument over the life of the swap. The total return pair payments would be similar to those of an investment in the underlying security exchange for LIBOR plus the spread. If the pair owns the reference asset, the total return would allow owners to transfer the credit or asset to the receiver. If the pair does not own the reference asset, the total return swap cash flow would be similar to those of taking a short position in the bond. If the value of the bond declines, the pair position gains. If the value of bond increases, the pair position loses. Conversely, the cash flow of the receiver can be viewed as a total return on a reference asset, which is a floating rate obligation. Although the pair counterparty receives ownership of the asset, the receiver is exposed to capital gains or losses and the credit risk of the asset. The spread above the floating rate that the receiver is obliged to pay depends on the credit risk of the reference asset, the credit worthiness of the receiver, and the correlation of the credit quality between the reference asset issuer and the total return swap. Now we move to derivatives with credit risk. Define a vulnerable option. Explain how credit risk can be incorporated in determining option value. A vulnerable option is an option with default risk. An option holder receives the promised payment only if the seller option is able to make the payment. Without default, the holder of an option gets S minus X and comma 0. The vulnerable optional receives payment only if the value of the counterparty V is greater than the required payment and the payoff is vulnerable. The correlation between the value of the firm and the underlying assets PVS is important in valuation of vulnerable option. PVS is strongly negative, then vulnerable option is little value because the firm's value is low and the vulnerable option is to occur paid. PVS is strongly positive, there is no credit risk because the firm is high and the value of equity is high. If the options have credit risk, then a derivative contract can be written to eliminate credit risk. The price of the vulnerable option can be estimated, then the price of the credit derivative to ensure vulnerable option can be determined. The payoff of the option used to hedge the credit risk of the vulnerable option is max S minus X minus max min of V into S minus X comma 0. An alternative approach computes the probability of default and recovery rate estimate if default occurs. The value of the option is the weighted average of the option price without the default. Following the approach, the value of vulnerable option is 1 minus PD into C plus PD into RR into C, the old formula that we have always been looking. So suppose a firm has a debt issue and a probability of default 10% and a recovery of what is the value of the vulnerable option? The vulnerable option is 1 minus C, 1 minus 0.1 into C plus 0.1 into 0.4 into C. So that's 0.94 into C. Therefore, the vulnerable option is 94% the value of the option that is free of default risk. Moving to the last topic, explain how to account for credit risk exposure in valuing a swap. The credit risk in a swap can be reduced by requiring a margin or by netting payments. Netting is a method where payments are offset so that only one party needs to make payment. The covenants of the swap agreement can affect the credit risk exposure. Suppose the counterparty that is due to receive net payment is in default. The swap agreement has a full two-way payment covenant, then the counterparty still receives the net payment. However, if the swap has limited two-way payment covenant, the obligations are abolished if either party is in default. Valuing a swap can be simplified by considering a swap with one payment. Suppose there is one payment is to be made in the swap arrangement between market maker and risky credit, which has no liabilities at the creation of swap. The agreement provides the risky credit to receive a fixed amount F at the maturity to a variable amount S on some index. The index could be based on equity or based on a floating rate. If the payment terminated, market will receive the difference between the payments, and there is, assuming there is no default risk, we can calculate the payoffs. Now, if the risky credit's ability to pay is uncertain, then the payments will be received from risky is smaller than the original payment that you should receive. When we consider the default risk, it would be max of F minus S comma 0, max of min of S minus V, S comma V minus M. Or in other terms, we are calculating whether they have that money or not, and if they have that money, if they don't have that money, then they can pay only the remainder of the money. For market makers, the risk-free counterparty, the payoff swap is same as the portfolio of a short position on the put option and long position of the call option. The put is written on the asset with the value S and extra price F. The call option is written on the lower of the variable payment. The correlation between firm value V and the variable system S is critical to valuation of a swap. If the correlation declines, there is no effect on the value of the put option, but the value of option on two risky assets decline. So that was it. I'll quickly summarize the same thing in 2 lines. In a risky swap agreement, the correlation between risky counterparty firm values and the payment option is critical to valuation of swap. If the correlation declines, then there is no effect on the value of the put option, but if the value of the option on the two risky assets decline. So that was it. I'll quickly talk about a few more things here before we end this. So what are the characteristics of KMV? The characteristic of KMV, that is estimate firm value based on correlation between observed equity values. So that was the characteristic of KMV. Now for credit risk plus, each obligation has its sensitivity to each common risk factor. So that's credit risk plus. Now most firms have a variety of debt instruments that mature at different time at different coupons. It's not just zero coupon assumed by Merton model. Merton model assumes that the underlying follows a log normal distribution with constant variance. The Merton model does not allow for firms to jump. Since most prices are surprised, the inability to have jumps in the Merton model makes default too predictable. When the firms have outstanding subordinate debt, they are experiencing financial risk. Changes in the value of it react to change model parameters in the same way as equity. Since the equity is valued as a call option, the decline in volatility will reduce the value of the equity and the subordinate debt. When firms with subordinate are not experiencing financial stress, high value firm changes in value of subordinate debt will be same as senior debt. Since senior debt is valued as the difference in the firm less equity, call option or Merton model, a decline in volatility will increase the value of senior debt and subordinate debt. So that was the valuation of subordinate debt. So this will do it for this session. I hope this added something to your knowledge base. If you have any doubts, you can just let me know and we can have this one more time. Thank you.